All right, disclaimer. I am not a financial advisor, and this is in a way financial or trading advice. I'm simply sharing option trade strategies that I use and have been successful within the stock market. This presentation is for educational purpose only. There are significant financial risk involved with trading, and I'm not responsible for your losses in the market. You decide to utilize the information and strategies discussed within this presentation. By choosing to proceed, you are acknowledging your understanding of the disclaimer. All right, so got that out the way. Delete that. All right, so for SPX, going over this, and I'm doing it because a lot of people want to trade SPX, um, especially the way that they've seen me do it. So I had like, I would say maybe three great trades on SPX, but I'm just gonna go over like the main ones that I remember, which would be this one right here. So on this day, just to delete all of this forward. So how I like to trade SPX is I like to I still use multi-time frame analysis. So what am I doing? I'm looking at the hour, the 30, the 15, the 5. If we're 2 hours into the trading day, I like to also look at the 2 hour time frame. And I'll also look at the 4 hour time frame, right? The reason why I'm looking at all these different time frames is because it's the intraday time frames, and I like to do a top-down multi-time frame analysis. And so going into the day, whenever I'm trading SPX, I'm not really usually marking the previous day high or the previous day low. Although this script that I use, Strat Teach V2, it's I'll type it in. The Strat Teach V2, it does, mark the high and low of the day for you. All right. So a lot of times what I'm doing is once the day starts, I may look at the day, or before the day starts, I may look at the daily. A lot of times I look at ES. The reason why I look at ES is because ES, SPY, and SPX are essentially like the charts are essentially the same. They're just different instruments. One's the future, one's the index itself. The other is the ETF. And so a lot of times I have all my broad information still drawn on ES. So I'll look at ES, and sometimes when we're running into, let's say, an area of support or resistance, we're running into something on ES. All right, so that's why I use ES in conjunction with SPX. Is because just because we hit lower ADR on SPX doesn't mean we hit lower ADR on ES. So sometimes we'll hit lower ADR first on SPX and then go hit it on ES, or sometimes we'll hit it first on ES and then go hit it on SPX. So that is ultimately why I look at both. All right, it's because again, I already have most of my broad information is drawn on ES, and ES has more data because it trades basically like 23 hours, 6 days out the week. All right, because remember, ES is going to open here within the next hour. I want to say, let's see, yeah, ES will be opening here at 5 o'clock Central, 6 o'clock Eastern, right? So ES is about to open, and it basically trades all the way until like an hour after market close, and then it closes for an hour, and then it opens back up. So ES has the most data, and also has the most volume. Most people trade futures, all right? People aren't really trading SPY and QQQ, pre-market or post-market. A lot of times they're trading, at nighttime. They're usually trading ES, and if ES has went all the way up or all the way down, that's why SPY and QQQ are like gapping down. They usually follow. They're relatively close to each other, but a lot of times people are saying that it follows the futures. All right. So because I have all my broad information is drawn on ES, I tend to just look at ES, and then that kind of helps keep my chart clean, unless there's a broad information I see on SPX that maybe I didn't mark on ES or something like that SPX is running to. Then I'll draw it on SPX. All right. So let me just hide this right here. So essentially, what I'm about to first explain is the trade that ended up going 1,000%, which was Monday, right? So what I ended up seeing was top-down analysis. Let's go to, I want to say, the 2 hour. All right, at the time of looking at it, right, the 2 hour, I want to say, was just this two down candle. All right, we look on the hour. Well, actually, that hadn't happened yet. So now I remember. All right, so what happened whenever I was looking at ES Monday, what I was looking for is for this 2-hour candle right here. Let me draw an arrow to it, right? This 2-hour candle right here. Matter of fact, I got a better way. I forgot I can annotate with this. This 2-hour candle right here. At the time, it was still an inside candle. All right. And what I was initially hoping for was for us to close inside 2-hour, because whenever I started looking at it, it was 11:45 Central Time, which would be 12:45 Eastern. I was looking for this candle to close inside and do an inside break, kind of like you can see it did back here, where this is that same like 10:30 to 12:30 candle. We get a new 2-hour candle at 12:30. And the same thing right here. What I was hoping for was like this, where in this case, it would have been a 3-1-2 reversal. In this case, it would have just been a 2-1-2 reversal. So I was initially hoping for an inside break. But what I ended up noticing was when I go down to the lower time frame, let me clear out this annotation. All right. When I went down to the hourly time frame for the 1 hour, at the time at 11:50, I looked at this time frame, right? And I seen that we end up having a 1-2-2 reversal setup. Then when I went to the 30-minute time frame, we had already triggered around this time, we had already triggered the 2-1-2 reversal. Now, a lot of times the best setups, and I mean the best setups, is whenever you're trying to get a reversal like on the 30-minute, and whenever you hit price target, that triggers the hourly reversal. If you pay attention to my watch list and chill videos, that's a lot of times what happens with the 4-hour entry. The 4-hour entry, if it hits price target, triggers the daily entry, right? Or the daily being directional. This is the type of trade that you want to line up where you get directional when you hit price target. And essentially, ultimately, after you hit these inside candles right here, you hit this low. That's when we got directional on the 2-hour time frame. So when I seen that we were breaking, I immediately went to the 1-minute time frame at this time, and I end up getting in at 11:53. All right, so it was right here once we started to break the hour. I got in here, and then ultimately I just ended up holding it because I seen that we were going into the gap. I ended up holding it to lower ADR. That was my target. Now, what's my mental when I'm thinking about this trade? Whenever I'm looking at it, at the time, and this is a tool that you should get used to using, is the price level tool in TradingView, or price range. And so what I did was I would go from high right to the low of the day. Essentially, it's going to tell me at the time. I don't really have to necessarily do this aspect from here to here because ATR is going to tell me, but I want y'all to know what the the DTR is. So in domino effect, I call it a snowball effect. I've never referred to it as a domino effect. I've always say like snowball, because it's like from top down analysis. And when you start to get a snowball, or basically like an avalanche effect, it starts usually at the top of the mountain. As it keeps going down the mountain, it gets bigger and bigger and bigger. That's kind of like how I prefer to look at it. But essentially at the time we had only moved $18 of the ATR. So the DTR would have said 18 at this time, right? So in my mind, I'm saying, all right, we can move $79, right? Potentially. So if I take the price level tool, or you do some quick math, either or, whichever one you're better at. Let me do this right here. And I draw down the extra, would it be 18? Be like an extra 50 or $61. Let's see, 61. Right? If we move the full ATR, we could potentially get down to 38.22. But what I ended up grabbing, I believe I ended up grabbing like the 38.60. I grabbed the 38.60 put strike, just because at least it would be in the money by the time we hit ATR. Well, ADR, my bad. It would be in the money by the time we hit ADR. And if we kept going past ADR and we moved down here, obviously I would be up a lot, but I end up taking it just at 1,000%, just because my main goal was just to hit lower ADR at this time because we were already getting towards the back end of the day, right? And I was really focusing more so on the 2 hour break. And I realized that I could make, 1,000%. And that's why I ended up getting out instead of holding for what ended up could have been, you know, instead of 110 to 1100 or $11, right? For my 1,000%, I could have had $110 to 4K if I would have actually got in down here. All right. So ultimately, that is why I ended up, grabbing that strike that I did. I made sure that before I even got in, whenever I was initially even looking at it, before I realized how far we were breaking, I, quickly grabbed the contract that I felt was cheap, which was, the 3860. And I analyzed if we hit 3854, what would be my, what would be my reward? And that's why I was able to hold through these little pop-ups right here. Cause at one point I was up like 100%. When we pulled back, I was only up 10%. A lot of people would have, got out right here. Well, actually, no, I'm sorry. That wasn't the one. It was actually right here. All right. A lot of people would have got out. I didn't get out. I stayed in it just because I knew what my plan was. And I knew we had a gap to fill. And I was just betting on us filling that gap. Sometimes you're going to be right. Sometimes you're going to be wrong. But to me, the whole point of trading SPX for me is to turn a little into a lot. I'm not trying to take, because SPX can be expensive. I'm not trying to take 600 and turn it to, 900. You know what I'm saying? Go from $6 to $9. I'm trying to take the smallest amount and turn it into a lot. So that's the first trade idea, right? Where I know that we moved only $18. The ATR is 79. I'm never stretching it to the point of I'm trying to be a hero zero to where I'm picking a strike where we would have to move the full ATR to get. All right. I'm trying to do it to where I'm already in the money and I have plenty more to go on the ATR. Right. I'm never doing it super far out. Now, had it been earlier in the day, maybe I would have went because actually on this day, I tried to grab the 3850 put initially. I got stopped out and I tried to do the 3855 and I got stopped out. So two losing trades before I got that home run trade. But the reason why I went 3850 instead of 3860 in the day is because we hadn't moved that much and we were earlier in the day. Because also the other mentality that you got to have is the further in the day you get, if you haven't moved that whole ATR or you're not close to moving at least, maybe 40% of it, it may be just a choppy day. So that was like another thing in my mind that I was thinking about. Whereas earlier in the day when I tried to at like, I want to say it was like maybe 10 right here when I initially tried that time. And I want to say before that, it was like maybe here. I tried the 350 was because we were earlier in the day and we have, a whole nother, 4 or 5 hours to move, another 50, $60. So that's the other thing you gotta, think about. It's all taking calculated risk and really planning things out fully and being reasonable. These trades, even though they're far out the money, it's still reasonable in my thought process. I'm not, you know, being delusional in what I'm picking. It's definitely very realistic, right? So that was the reason why I did the 3860. That was my mentality. How much of the ATR we moved, how much more could we move? And then I'm going far out the money and I'm picking it like that. And I've just been grabbing one contract because again, one, I need to fully understand how SPX moves, and anybody else, you should want to fully understand how a stock moves, especially if you're going to be, because these are 0 day expirations. I want to remind you, 0 day expirations. You don't want to lose a bunch of money trying to figure something out. All right. Or, I'm try to let your ego get in the way of things. All right. What's a good ATR for when you're shooting for $1 or two move? I don't look at it, I don't do it ATR. I don't, trade a stock because of this amount ATR or this and etc. I don't, do that type of thing. So I don't understand that question. Because again, I'm only using ATR and SPX and a lot of other things just to see are we moving more than what we normally move. Because again, if you go watch the class on what is ADR, that's where I explained the upper and lower ADR and why I put these two together in my script to know what the ATR versus what we're moving that day in reference to the lower ADR and the upper ADR. Because sometimes we'll break through the lower ADR or the or we'll break above upper ADR, but that doesn't mean we've moved, the full ATR that we move on average, right? ADR is an intraday strategy, whereas the ATR is in reference to that period that you're looking at. I have my ATR set to give me, the um 14 daily period, which what it does is it takes the last 14 days, it calculates the range, and then it divides it by 14 to give you the average. All right. I have it set to the daily, but I can also figure out what the weekly ATR is, things of that nature. But I'm using ATR to help me pick strikes for SPX, whereas normally with other stocks, because it's not a 0 day until Friday, I'm picking those strike prices based off of me hitting my price targets. All right. Because those are, day trades that, if you want to make it a swing trade, it could be a swing trade. All right. Versus this is clearly just a day trade. Right. And I don't want to pay a lot, you know, for SPX. I'm trying to pay the least I can pay to make the most. I'm trying to get the most bang for my buck because it's so volatile and because you can easily get clapped playing a lot of money, especially if you're just going to chicken out and get out, at 40, 50%. I'd rather you risk a little and make more. So that's just my mental, as far as trading it. So now if I go forward to Friday, that's like the other trade I remember because this week just been a lot. It's kind of been crazy for me. Um, Friday with SPX. And again, I'm always entering off the 1 minute, but I always do a top down approach. So if I go to the hour, which I entered SPX at 10 o'clock Friday for the $2 to $12 trade. So basically I turned $200 into 1,000. Whereas, that first trade I showed you, I turned 100 to 1,000. Basically what we had going on at 10 o'clock was, if you look at it, 10 o'clock would have been the last 30 minutes of this hourly candle. So when you're looking at time frames, understand this. If you're looking at, well, first and foremost, understand that time frames flow together. All right. And it's just different ways of looking at the overall information. Remember, if price is at 39.66, right, on the hour, it's the 39.66 on the 30, it's 39.66 on the 15, it's 39.66 on the 5. The only difference is how they're grouping the candles together, how they're grouping the price action, right? The data. So when you looking at the hour, a lot of times what I like to do is I'll take my trend line tool, and if I'm on the lower time frame, I start to mark 10 minutes or 15 minutes before the next flip, so I can see how that price is going to move, how price action is going to move to set up that flip. Sometimes there'll be a TTO right before the flip where if you just held it that extra minute for the flip, it goes right back in your favor. All right. Or sometimes the setup might be right before the flip. Maybe it's reversing the setup on the flip, set up a reversal, and all the time frames start to align for reversals. So on the hour, you see we had went 3 the first hour, right? So at 10 o'clock, on the 10 o'clock flip, you notice on the 30-minute chart, we had a 2 up, right? So at 9:30, right, we pushed up, we created this 2 up candle. All right. And then on the 10 o'clock flip, right, which is what I was looking for and I entered on, right, we set up a potential 2-2 reversal back down. The other aspect I want to go to is the 15-minute. On the 15-minute, on the flip, right, we were setting up at 10 o'clock a 1-2-2 potential reversal. All right. Now, the other aspect, if I go down even lower to the 5-minute, and again, I'm doing this all while trading is actually going on. This is why I entered at 10. We also had an inside 5. Right. And if you notice, there's this gray line right here. This gray line is the open of the day. So literally at 10 o'clock, when we got this 2-1-2 reversal, even though I entered on the 1 minute, I already knew about that, 2-1-2 reversal, which on the 1 minute, it was just a continuation. Right. I knew we were crossing back below the open of the day. So now with the 10 o'clock flip, essentially, right, your 30 is red. Your day is now red. Now it's just about where was your hour open at, which if we go over here to the hour candle, we would know our open on the hour is right here. So let me turn back on the magnet. We take the hour red right here. So now we have full time frame continuity on the day to the downside. All right. So off of this right here, I'm like, all right, we're going to get the reversals. And when getting these reversals, we're also going to end up taking the hour red. So I'll have day trading time frame continuity to the downside. So I enter, all right here at 10 o'clock. And this doesn't phase me just because, again, I entered right here. We didn't break above the open of the day, and we didn't break the candle that I entered on, right? So this is my entry candle. We didn't break above it. So why I was able to hold this is because you see just on the 1 minute, we end up gapping down, right? So it just basically, this was a gap fill right here. And essentially I go down right here where we hit lower ADR. I didn't take it right here. I was at 300%. Reason being is just because I'm like, we're hitting lower ADR. If we can just at least break above that. And then I had this broad information this top I drew the other day. Where is that? I don't even know where it was drawn off of, but it was basically drawn from way back here. Oops. Which is not letting me really show too much on the 1 minute, but it's drawn way back there. So I was like, as long as we can stay below this broad information top, we'll be good. If you're looking at it on the 1 minute, it's going to look crazy. It's like, oh my gosh, price action is pushing above it, above, the broad information. You see it closed above it right here. But this is where you have to be patient, right? Because if you use multi-time frame analysis, which I'm about to show you, we go over here, you'll notice that time where it was popping up, all right, which was this candle initially broke back above. But when it did it again, it was just an inside 30 minute, right? So me not trying to anticipate the reversal and just hop out of the trade helped me to hold it longer. Me realizing, oh, it's just the inside 30, is probably just corrective activity. All right, if I go back down to the 1 minute, because I'm still using multi-time frame analysis whenever I'm in the trade, right? And once we broke below, and my target was 39.50, which is like right here, I ended up getting out the trade. Now, had I held it 9 more minutes, right? Because I got out basically right on this green candle, right here. It's basically between these two. That's when I got out. If I would have held it a little bit longer, I got out at $12 right here, but it ended up going to 19.10. So that's close to another 1,000% trade on SPX, where I could have turned $2, which maybe when it moved down to here, maybe it got up to being worth $20. But basically, I know for a fact it got to 19.10 right here. I could have turned $2 into basically risk $200 to make 1,700. All right. Whereas I end up just making 1,000 off of it, which is still a great trade. So ultimately, again, it's the same thing. Whenever I got in trade, I was just going over the entries, but it's the same thing. If we do the price level tool, and up until whenever I got in the trade, which was like right up in here, we go from lower day right here to high day, we move $28, right? ATR is 78. So if I go from lower day, turn off this. If I go from lower day, right, and I draw down the extra $50 we could go, which I just do 48. We could have got all the way down to 39.35, which obviously we didn't get all the way down there, right? We end up starting to go back up here. But also this time for my strike price, I picked, what did I pick? I can't even remember. Hold on, let me check, see if I could see what strike price I had. I know I picked 39.60. That's what I picked. I picked 39.60 just because it was slightly below lower ADR. And I felt like if we just hit lower ADR, it would just make sense to take that. And I also picked it because it was only $200. Obviously, again, I don't really want to pay more than $250 for an SPX contract. So I went with something that was relatively cheap. And obviously, unlike whenever I hopped in before for puts, which was at 11.53, this time I hopped in at 10. So the further in the day you go, the contracts start to get even cheaper. So because I was earlier in the day and I was before basically noon, and I wasn't even near noon, it still had like another 2 hours to go before noon. I went with the 39.60 again earlier in the day. So it realistically moving the rest of the ATR made sense. Us potentially getting below lower ADR made sense. And that's why I shot for what I shot for, as well as with ES on Friday. SPX hit ADR before ES hit 80 lower ADR. If we look at the time, we'll see SPX hit lower ADR at 10:37, whereas ES didn't hit lower ADR until 12:30. So that was like my next price target. Like, well, if ES hits lower ADR, that might be another good place to take profit for SPX, but I didn't end up holding that long, which if we look at 12:30 and we go back to SPX and we hover over to 12:30, you can see right here where it initially bounced for ES, right? SPX tried to do something similar. If I actually take this down to the 1 minute and look at it. Right, you see 12:35 was where we bounced for ES. We're trying to bounce off that broad, off the lower ADR, and you'll see SPX is doing the same thing at the same time. So sometimes when you don't know why SPX is running to resistance, it could have something to do with ES, which for ES it was hitting lower ADR. The dollar amount change. I'm using price range tool as far as like what I'm drawing. Let me go back over here. So as far as drawing this is price range, which is right here. It's the 1, 2, 3, 4, 5, 6, 7 down panel to start messing with. And then as far as my ATR, DTR, this is just the script that I made. So that's ATR versus DTR. Oops. So this is my script that I created, that I use as far as for lower ADR, upper ADR, ATR, DTR, all of that's in one script, as well as, the 50% lines, which I don't have on here right now. But it also gives you the open of the day. So it automatically gives you the open. So you don't have to mark it yourself. So all of that is in one script. Again, plus the 50% retracement lines. Well, the 50% lines, which is I have it automatically set to 1 day and 1 hour. But you can go in there and change that, as well as if you want to see the weekly open, you can do that. You can also change the periods for the ADR. Most people do 5 and 10. I don't know what else other people do. Um, Also, if you want to hide the labels of it saying like open and stuff like that, you can turn that off. And then if you want to change the calculation period for the ATR, you can do that. So a lot of things you can do with that script I created. So yeah, when you hit the 50% mark and see less volume, do you leave some runners just in case for your analysis if it can? No, I've only been grabbing one contract. Um, and I know what my goal is. With SPX, it's kind of like one of those all or nothing type of things a lot of times that I'm mentally doing, just because I know what SPX can do. And I know that I'm getting my entries off the 1 minute. So I'm getting like very precise entries. With SPX, a lot of times, like here, I entered off a continuation, but it was a reversal on a higher time frame. A lot of times on the 1 minute, I'm trying to get in like near the reversal. Right. So you can see, even though I took the continuation candle right here, I was one candle removed from a 2 up, 2 down reversal. So at SPX, a lot of times on my entries, I'm either taking the reversal candle on the 1 minute, or I'm taking like the entry is one candle removed from the reversal candle off the 1 minute, because I want those very precise entries, because on SPX you can be down 30%, 50% very fast. So I'm doing very, 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 very tight, precise entries. And that's why I'm even on the 1 minute. ATR versus DTR. Um, ADR is the average daily range. All right. It's an intraday strategy. So what it does is, for the 5 period, what it does is it takes the intraday from high to low, right? For ADR, it takes the intraday high to low, which usually doesn't have any gaps, right? And it's going to take that, and it's going to take 5 days worth. It's going to take that number. It's going to add them together. It's going to divide by 5, which is going to give it the average for 5 days. Then when the market opens, what it's going to do is, when we get the open, right, in that average range from the last 5 days, what it's going to do is it's going to divide it by 2, and it's going to subtract that number from the open. All right. And then it's going to add that number from the open. That's where it's going to place your ADRs. So from the 5 for the 5 day, it's going to subtract. It's going to give you, I forget which one of these is the 5 one and which one's the 10, but it's going to give you a 5. And then it's going to do the same thing for the 10-day ADR, right? Boom. And then it's going to add it to the top. Essentially, like if I was to give an example, let's say the average daily range for something is 5. When the market opens, it's going to divide that number by 2, which will be 2.5. And let's say the opening price was $80. It's going to subtract 2.5, which would be 77.50, right? That's where you would see a lower ADR line. And then it's going to add it from the open, which would be 82.50. And then that's how you get in your higher and lower, because price action doesn't know if it's going higher or lower that day. So what it's going to do is going to give you the upper range and the lower range. All right. So that's ultimately what's going on as far as the ADR and the calculations for the ADR. And essentially it's just looked at as support, lower would be support, upper would be resistance. All right. And then when price starts to break below that, it's just like you breaking through, a critical support level. All right. Once you break through it, support becomes resistance and stuff like that. But essentially, usually when it breaks below ADR, you're getting a breakout, right? And if it breaks above ADR, right, you're getting a breakout, because it's basically picking a side to go in. But that's why I have the ATR and DTR, because just because something broke below lower ADR and is pushing below lower ADR, or broke above upper ADR and is pushing above upper ADR, does not mean that it's moved more than it moves on average. Like we went below the lower ADR for SPX, but we didn't move what we normally move on average, right? We moved $73.58 Friday. We normally move 78.69. So we went below lower ADR, but we didn't move more than we normally move. All right. So that's just to help people keep up with, are we moving more than what we normally move? Because some people, the first time they see a reversal against them below lower ADR or above upper ADR, they get out saying, oh, it's probably an exhaustion risk. When it's like, it ain't even move what it normally moves. So, keep calm. The other aspects that I use to keep me in trades is I use the counter trend candles and order blocks to stay in trades, which is obviously a part of ICT. So like for instance, when we were pushing down, what I like to do is I like to use the green candles as resistance, but I use it once we push through a level, right? So what I mean by that is right here where we go back down, all right, with this red candle, obviously it's painted blue because it's a outside candle, but it's a red candle. You can see the border. What I'll do is I'll take um, yellow lines, and I'll mark the low of the green candle, and I'll mark the high of the next green candle, which will give me like the next range of when we pop into it. Friday, whenever I was looking at SPX and I posted the SPX chart, I talked about how we created an order block right here. So you have bullish and bearish order blocks. All an order block really is when price delivery changes. So right here we see where we have what ICT would call as up close candles, which just mean green. Down close candle means red. So we have two up close candles back to back, right? So the order block, once we break below the open of this green candle, right? Because it's basically the two green candles or however many green candles before you see the red candle and before we change price delivery. Because essentially how ICT describes it as the algo was basically doing buy and it ended up changing to sell. And so next time price pushes back up here, if I mark the open, because it's usually the open of the first green candle and the high of the last green candle before the price delivery change, which the down close candles indicate we went from buy to sell. You can immediately see it, green, green, red, 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 right below the open. Next time we push back into the order block, a lot of times price will reject from it. Now, the best order blocks are it would just be ADR for TOS. But the next time price push the qualified and the best order blocks are order blocks that have fair value gaps in them, which is why you see this box right here. Now, essentially a fair value gap, let me move this out the way. A fair value gap, you will look at 3 candles. All right. When you have price delivering like this, right, you look at the first candle, the second candle, and the third candle. The low of the first candle, and this for basically a bearish FVG. The low of the second candle, first candle, to the high of the third candle, there's a gap in there. You don't see the wick, right? Whereas if you look at this and we go 1, 2, 3, there's not a fair value gap right there. Why? Because you have that wick. All right. There's no box there. Whereas if we look at right here from high, from low to this high, there's a little bit of a gap in there. That's basically the fair value gap. Every fair value gap isn't important. I just mainly focus on the ones that were created within the order block, which lets me know that's a valid order block. All right. And you see right here, when price wicks into this order, into this fair value gap that's in this order block, we immediately reject, right? And that sets up that inside candle for where I end up taking this reversal down. And this was posted in the chat before this even poked back into it. Whenever we were poking back in here, I was like, oh, we got an order block. It might be trying to go back into that fair value gap before, things change. We end up going back down. So a lot of times I'll look at that. I'll look at those type of order blocks and I'll see where that's created. Like for instance, right here, you get the change right here where you create this, bearish order block right here. The bullish order block would be like one we created down here. Whereas you see this candle shoots up, this would be the open, this would be low. That's your order block. You see price pokes back into it and you have the fair value gap right here. And then we end up coming out of it. All right. So a lot of times I'm using again, green candles and maybe order blocks that are created. That if we poke back into that, maybe that's where we reject. For instance, here was a bearish order block that was created right here. If I mark the open right here, the first green candle, and I mark the high, right? When I see price come back to it, right? And this is actually what helped keep me in the trade. I was like, there's a fair value gap that was created right here. So we poke back into this bearish order block, we probably may reject. It might just go for that fair value gap. It may feel the whole thing. Sometimes it doesn't. And maybe we end up going down from there. And then we ended up going down from there. The other aspect is just marking green candles. Now, right here where you see I would have normally marked this green candle, right? These two right here as potential places, areas of resistance. Next time price tries to come back in there and we reject, you see it right here happen. But then right here, we break into it higher, right? And then we come down and then you see we break above it. Well, the other aspect of what happens with price, especially with stuff like SPX, is they like to run stops before going lower. So the most common stop that SPX likes to run is swing highs and swing lows. So what's a swing high and what's a swing low? You look at 3 candles, all right? So will that also be a fair value gap? Yeah, it was definitely one in there. So what they like to do is a swing high is when you look at 3 candles. The first candle's high is lower than the second candle's high, and the third candle's high is lower than the second candle's high. It gives you that candle that sticks out like a sore thumb. Now in the strat, we would tell you that essentially, this is why we mark these price targets, that all these are obvious places where people put their stops, right? That's why we mark all these different price targets. Well, the actual truth of the matter is most traders are actually putting their stops behind these swing highs, right? They'll put, if they're going short, their stop is here to give price room to breathe. And if it's like a swing low, they'll put their stop right here. So a swing low, if you look at it, the first candle's low is higher than the second candle's low. The third candle's low is higher than the second candle's low. Creates that swing low right here. This is where the stops are actually being put, at swing lows and at swing highs. All right. When people are walking down their stops, they're normally walking down from this swing high to this swing high to this swing high to that swing high. And then that's when they run those people stops. We come down, run the lows, entice, shorts again, go back up, stop people who just went short right here whenever price broke below. And then we come down and we stop out those people who just tried to go long right here thinking that's the bottom. And then price takes another leg down. Because essentially you have to remove liquidity, you have to stop people out, entice the other side in, and then you run those stops. Now, why does that make sense? Because a lot of times people who are setting stop losses, they do market orders. right? Which are aggressive orders. All right. So with market orders are actually this what move the stock, what move price action. It's not limit orders, right? Limit orders are passive orders where, hey, when you come back, you get my order, you get my order. Whereas in this case, market orders are saying, hey, I want to get in or get out the trade right now. So if somebody has, let's say they tried to go long right here and they put their stop right here, they have a market sale. So if price action breaks below here, it's a market sale, which is going to be aggressive sell order. So it's going to take somebody who has a passive buy order out the market, which is going to shoot the price down. You understand? Are those AI pretty much TTOs? Yes, they're TTOs. And it's a better way of helping you understand, how to hold through a TTO by just using the counter trend candles. So in this case, green candles, because we're in a downtrend. If we're in an uptrend, it would be red candles. All right. But you want to make sure price is not actually ranging like it did in here. You want to do that when it actually moves lower. So for instance, in order for me to take this green candle serious as a resistance, we have to move down, which right here on this red candle, we actually move lower and past this basically level. So now we're not chopping. So when we poke back up on this green candle, it's actually being met with resistance right here. And on this green candle, we push down, right? Then I would mark this, basically I would mark the low of this green candle, mark the high of that one, right? We end up pushing down. You see there's this green inside candle in here. I will mark that out. You see we wick it, we push down, and then you see we come back up. We run into these two green candles, mark the low or mark the open, whichever one. They're relatively close to each other. Boom, we poke into it, we shoot back down. Now, once you start to see us breaking above, like right here is just ranging, but when we come back above it and we break above this basically just saying, all right, we swap to the other side, and then you see it come back and then shoot back up. So at that point, it's like, all right, I'm out the trade. Because now we're starting to shift into the opposite region, right? Because we end up pushing down off of this. We end up coming back up and we end up breaking through this right here, right? I would move it to like right here. Once we took this leg down, this validates these green candles in here as being used as resistance. And you see, initially we're in here, but once we break above that, all right, now we shift to the bullish side. You see it come back. All right. And maybe it created like a bullish order block on a different time frame. You see we come back and shoot back up, which also was like a fair value gap in here. Whew. All right. So that I know that was a lot. But you'll notice, like, whenever I have something to break down and we have, classes on this is going to be like most of the class because I want to thoroughly go through my mental while I'm picking the strikes the way I'm picking it, using ATR, knowing, using DTR because that's going to tell me what we moved that day to precisely calculate, all right, what we could potentially do the rest of the day. And that's funny. And this is why I'm doing it. This is why those things pay off. All right. It'll be able to be rewatched in Wealth Squad University whenever the upload is put, because obviously this was recorded. So this will be uploaded later. That's up to Ender. I don't do the uploading part. So you have to, talk to them about that. But this is how I'm picking my stuff smartly. So hopefully this leads you to understand that, all right, Ray isn't just pulling something out his butt, you know what I'm saying, to do. Like this actually game plan. This is not no lottoing or YOLO type of thing. You know what I'm saying? Like it's very thoughtful and very, calculated in how I'm trading SPX. I'm not just going a couple strikes out the money and hoping things work out. I'm trying to turn into a little into a lot by going way out the money. Right. And I'm using the Thinkorswim Analyze tab. So if I pull this up, I'm using all of this. I'm loading in the contract I would pick, and I'm using this to figure out how much I would make. For example, let's just say, to just show an example real quick. Let's say I thought that SPX was going to go back up to 4,000 tomorrow, right? Let's just say, we've been chopping around, tomorrow, and we've only moved $18, right? Well, 4,000, which is a psychological number. So I'm picking 4,000 because it's a psychological number. All right. And it's probably where maybe potentially ADR would be, upper ADR would be located tomorrow. Right. So let's just say price is where it is right now, 39.61. And let's say it's 10 o'clock, right? And I'm shooting for 4,000. And really, I believe it could get to, let's say, 4,010, right? So essentially what I would do is I would come over here. All right. I would load up the 4,000. And the first thing I would do is load up the strike price. And then I would load up 4,010. And I would say, oh, snap. I could potentially turn 185 if we hit 4,000 to 1,400. And if we hit 4,010, I could actually get 1,000%. And a lot of times what I do up until that point, I'll put in the in-betweens. Like I'll look at, would I be at 39.90? Would I be at 39.80? Would I be at, at 39.70? And then once we get above 39.70, then I'll put in 39.75. What would I be at? And I'm all at the time of as prices moving, I'm consistently calculating what I'll make, because one, that'll help keep me in the trade. But also, I sometimes, if price looks like it can't do it, then I just be like, all right, well, we're here. This is what my profit is. It's 300, 400%. I'll bow out the game. Where liquidity is usually under swing low or swing highs, which would be your short-term high, your short-term low. Let's see and pull, which would be your short-term high, your short-term low, or long-term high, long-term low. Like liquidity rests above stop losses, which is usually, again, swing highs or, essentially swing lows. So that's all ICT, right? So basically this would be, I want to say, sell side liquidity, because this is where shorts would sell. And this would be buy side. No, this would be buy side liquidity, because I think this is where shorts will buy to close. And this would be sell side liquidity, because this is where shorts would, longs would sell to, get out. So that's how you would figure out that. Do I have a lesson on it? I can't remember. Honestly, I've done so many lessons. I can't remember where that would be the case where I've went over that before. It might be in the class where I talk about getting ready for the next day. Um, but I can't think of, outside of that, because I think it's the lesson on preparing for tomorrow, or pre-market prep or post-market prep or something like that, preparing for the next day. And that would be, I think, where I went over the TOS tab. But so far, does everybody understand, my mental, how I trade SPX the way I trade it? I know it's different from a lot of people. I don't think anybody other than the people I shared this with in the Hidden Village, that's trading SPX by going far out the money the way I'm doing it, to get, that 300, 400, 500% type of thing. 100% is cool, but if I'm just only going to get 100% on SPX, I'd rather just trade something else. You can get 100% on anything. If I'm gonna get 100% on SPX, it's gonna be one for a cheap contract, which I think fits a lot of people's account. But I prefer newbies not try it yet. Fully learn the strat, fully learn how to trade before you're trying to trade SPX. Because you can get clapped pretty quick if your entries aren't precise. Because again, even before I took that trade that worked out Friday, I had got stopped out 4 times. And 2 of those times, because I had puts, the calls were the ones that were the actual L's, the 30, 40% losses, just because one of them was 40% because it changed on me so quick. But as far as the puts, they were up 60%, and then I just got stopped out at break even. Because I thought we would keep dropping. It shot up on me and it stopped me out at break even. Which I'm cool with. You know what I'm saying? Because for SPX, I will say I have more of a home run mentality, just because I know when SPX runs, whatever losses I garner can be wiped out in one trade with SPX easily. Like if SPX really moves, it can wipe out in one trade. It's where you're not honoring your stop losses and you're losing 50, 60, 70% on SPX, where a great trade won't wipe those losses out. Especially if you're buying a bunch of contracts or you're buying expensive contracts. The losses won't get wiped out. But with the being cheap and, looking at ADR, and using ATR and stuff like that to figure out where I should pick my strikes and things of that nature, and taking calculated risk, which as you can see, they're all calculated risk, it's panning out. And anytime I do lose, I get that right back. Like on the small account, I had lost that I took from 400 to 700 before Friday. I lost 100. So I went from 700 back to 100, right? And then whenever I was going over this on Zoom Friday, I end up canceling that $100 loss and getting another 100. So I end up taking that small account from 400 to 800 in a week, right? And I also got back that initial $100 loss on SPX the very next trade by winning 200, which could have got a little bit more out of it because it did drop a little bit lower. So it was a 100% trade. Probably could have got 150% maybe. But again, it's calculated risk, and it's basically trying to turn a little into a lot. And not buying expensive contracts, and just understanding the further in the day SPX goes, the cheaper the contracts and the quicker it's going to be for you to easily turn to get those 100%. Like I remember SPX when it ran to end the day. Hold on. I didn't trade this. I just want to put that out there. I did not trade this. But when SPX ran right here, I talked about this where this little move from here to here was 200% to end the day, Thursday when SPX just shot up right here. If you would have grabbed the 39.90 contract, this was a quick 200%. I can't remember if TOS would even let you buy a SPX contract that late into the day. But let's just say somebody had, that was a quick 200%. Even probably from here to here, probably would have been a quick 200% because you're so late in the day that anytime it really moves, that's the percentages are gonna add up quick if SPX really chooses to move. All right. So does everybody understand it? Can I get a 3 in the chat? And this is recorded, so you'll be able to rewatch it at your own leisure, take notes, all that other stuff. All right, great. Well, we're gonna go ahead and end the class. Next time I try to see if we have time for question and answer. But I feel like this was just a lot in one lesson, so it should give you a lot to mentally think about. And if you do have questions or you miss something, you will be able to like rewatch it. Um, so hopefully everybody understands that. When scaling in, do you wait for another stretch setup? You will wait for a reversal. But as far as SPS, it's not something I would practice scaling into. Um, but like let's say had I wanted to pick a spot to scale into SPX, it probably would have been like maybe here off this reversal back down. You know, like when you need corrective activity before you scale in. SPX is definitely something you don't scale in off a continuation. Just wait for reversal. Um, because again, it's something that can have you down really quick. I prefer you scale in off a reversal and just make sure it makes sense to even do that. So like when SPX pushed up right here, this probably might have been a potential, 2-2 reversal on the 5-minute. Let me see where it pushed up. So yeah, like from my entry, that little push up right there, right, was just a reversal on the 5-minute back down. That would have made sense to try to take it, off the reversal back down. You see what I mean? So that's the only time I would really just really scale in. And I would try to do it like as close to your entry as possible instead of trying to, add a contract like up in here. Because on days when SPX really moves, that makes sense. But when you're in that moment in your trade, you don't know if it's really going to keep going, right? So I'd rather do it right here, especially before we make that new low of day. So if it decides to really push below once we make that new low of day, all right, I'm already in. I got the contracts that I want. All right, I'm good. All right. So spread love, spread positivity. Love y'all. Catch y'all later.